Venture capital is often made to look super exciting and glamorous in television shows like Shark Tank, Silicon Valley, and TVF pictures. But in reality, it's far from it. It's often misunderstood and surrounded by myths. These misconceptions either make founders believe it's easy to raise money and start a company than it actually is, or discourage them from trying because they think it's too difficult. Hi, I'm Akash Bhat. I'm a founder and an ex-VC, and I've been on both sides of the table. Over the last few years, I've spoken to over 500 founders and narrowed down the top 10 misconceptions that founders commonly have about venture capital and investors. Whether you're gearing up to raise your first round of fundraise or just curious about the inner workings of venture capital, then this video will bust many of those myths and give you a clearer perspective. In this video, I'll cover 5 biggest misconceptions that founders have about VCs and share the rest in the next one. So let's break it down. First up is the overemphasis on valuation. A common misconception that founders have is that higher valuation is always better for them. But in reality, the focus should always be on dilution and the terms, not just the valuation. Valuation is one of those commonly misunderstood aspects of fundraising. Founders often chase higher valuations, assuming it's a sign of success. But what really matters is how much you're giving away and under what terms. Let me give you an example. Imagine you raise $10 million at a $100 million valuation. That means you're giving 10% of your company away to your investors. Now, if that investor has a 2x liquidation preference, they get $20 million back before anyone else sees a dime. Even if you sell for $50 million, they walk away with 40% of your company at exit and not 10%. Now compare that to raising $5 million at a $25 million valuation. Sure, you're giving away 20%, but with clean terms, no liquidation preference or other restrictive clauses, you retain control and set yourself up for a better long-term outcome. Before we proceed, let me share a little bit about what liquidation preference is. Think of it as a safety net for investors. If they invest $1 million and there's a 2x liquidation preference, they are entitled to $2 million before anyone else gets paid. This can heavily impact founder payouts during an exit. So next time you evaluate a term sheet, don't just focus on the valuation number, look at the dilution and the terms. A good deal balances both the growth capital with founder-friendly terms. Next up, my pitch deck needs to be extremely pretty. Many founders spend countless hours trying to make their decks look visually appealing. I in fact know people who have hired designers to help them create decks, when in reality, they should be focusing on substance and storytelling. You don't need a pitch deck to raise money. We in fact didn't even have one when we were raising our round. Instead, we focused on writing a memo, which was made simply on Google Docs. Why? Because a memo lets you dive deeper. It's a chance to tell a story beyond just a pitch deck, showcase your expertise, and share unique insights you've uncovered about your industry. It's not just about what you're building, but showing investors that you deeply understand the problem and why your solution matters. Amazon under Jeff Bezos embraced this approach beautifully. He once said, "We don't do PowerPoints at Amazon. Instead, we write narratively structured 6-page memos." It's harder to write a good memo than a bad one. If you have to write a memo, you're forced to deeply understand what you're talking about. And this applies perfectly to fundraising as well. It's not about flashy slides, but demonstrating thoughtfulness and clarity. Let me break that down for you. Well, here's a memo of Lean. The first thing that you notice is that we have a one-line description. It's always helpful to describe your company in relatable terms by framing it as X for Y, where X is a well-known company and Y represents your industry. For us, it was Plaid for cybersecurity. For you, it could be something else. Next, our memo clearly defined the problem at large. What is the issue we are solving? Who does it impact? And why does it matter? Explain what's happening as a result of this problem. What are the current consequences or inefficiencies caused by this issue? Identify who faces and suffers due to it. Which groups? customers, users, industries are directly impacted. Describe how big the problem is and what context you need to make decisions, especially around data. Then, to communicate effectively, use a simple diagram. Use visuals to explain the problem if possible. A picture speaks 1,000 words, so this will make your concept much easier to grasp. Next, we proceeded to propose the solution. Explain how you intend to build it. If it's a technical solution, include an architectural reference or a diagram describing how the solution works. If you're an AI-based company, it's important for you to talk about your proprietary data models. Go deeper into the solution. Then, talk about your go-to-market strategy and early customer adoption. How will you get users or customers, and what traction can they expect? Highlight the use cases for your solution. Show how it will create value for your customers. Next, there's a total addressable market. This is something VCs often love to see. But in my opinion, it's not that important, but you should include it in your memo. If you don't have it clearly defined or have hard data numbers, you can create one, but make sure that it's realistic. You either use a top-down or bottom-up approach to demonstrate the market potential. The goal here is to show how big the market is and prove that capturing even 10 to 30% of it can make your company worth $10 billion or more in the future. Finally, include information about the team and the fundraising terms. Highlight the team's credentials and why you are the right people to be solving it. Share the fundraising terms or the unique approach you're taking. For example, we raised in tranches. I'll explain that in my next video. Lastly, this is a tip that I'm handing out to all founders. Include an FAQ section towards the end of your memo because it's a critical opportunity to stand out to your investors by preempting the questions that they might ask. Every new question that comes up and every new conversation that you have, start including it in your memo. Make it an incremental section. This is a great way to position yourself as thorough and prepared. Third, VCs are risk takers. The biggest misconception also is that they love taking risks and will invest in ambitious ideas, when in reality, most of them are driven by momentum and FOMO. Let's take this example. Chamath in the All In podcast openly admitted to following a FOMO thesis during the early AI wave. Many VCs don't fully understand the technologies that they're investing in or the sectors, but feel that they're compelled to invest because everyone else around them are doing it. This was a very common approach that many investors took during the pandemic years, where they invested in sectors they didn't fully understand because of the buzz. For example, crypto and Web3. For founders, this basically means two things. First, build enough buzz to create FOMO. This could be by getting an angel with a strong reputation or building social proof through press or early customers. And second, understand that VCs often follow, not lead. Your job is to position yourself as a hot deal that they cannot afford to miss. Number 4, big fund equals big value. Big funds provide more resources and support is what most founders think, but at pre-seed and seed, you are just another investment for them. Let me break this down for you with simple math. A $50 million fund writing you a $1 million check means you're 2% of their portfolio. If your company succeeds, it could make a meaningful impact on their returns. Now compare that to a $1 billion fund writing you the same $1 million check. You are 0.1% of their overall portfolio. No matter how well you do in the early days, it barely moves the needle for them. They are focused on the bigger bets that they have placed. Smaller funds often care more about your success because they're betting on fewer companies. You are not just a number, you are part of their thesis. Bigger isn't always better. Find a fund where your success actually matters. Number 5, revenue is a must. The misconception here is that you need revenue to raise some capital. But let me tell you this, storytelling matters more in the early stages than revenue. Brian Chesky of Airbnb famously said, investors bet on people and potential and not spreadsheets. While revenue is obviously important, VCs often prioritize growth potential, scalability, market size, and team capability over short-term profits, especially in early-stage investments. Early-stage fundraising is all about the story that you can tell. Can you articulate the problem clearly? Can you show why you are the team to solve this problem? Revenue helps, but not always necessary. In fact, when we were raising our first round, we focused on painting the problem vividly than on revenue. In fact, we had zero revenue. We tailored our pitch to every investor and what they cared about. Some cared about market size, while others were more behind the technology that we were building and the architecture that went into it. The key is to understand your audience and study them really well before you pitch to them. Thank you for watching, and I hope this was helpful. Stay tuned for the next part and make sure to subscribe so you don't miss it.